If your concentration breaks before this ends, ask yourself, who benefits when you stop paying attention? Not you. Every detail connects. Miss one, and the whole picture falls apart. Now let's break down exactly what went down. COMEX March silver open interest collapsed to just 10,526 contracts. That's a drop of 11,356 contracts in a single trading session, more than a 50% wipeout overnight. Delivery obligations fell from over 110 million ounces all the way down to 52.6 million. Then came the pause. During Wednesday's metals trading suspension, 31,828 contracts exchanged hands while everyday retail traders were completely locked out of the market. When the market reopened, silver had already been knocked $4 lower. Then another wave hit, and another. Wave after wave, until silver had been pushed down roughly $6, dropping from 91 to 85 through a sequence of clearly coordinated moves. That was not natural selling pressure. Peter Brandt just changed his tune. He's now publicly discussing legal action against the CME. When a veteran trader who built his entire career on pure technical analysis admits the system is broken, you know Wednesday's intervention was impossible to hide. When someone of that caliber speaks up, the market notices. In the previous video, I pointed to the 150 EMA on the hourly chart as a key level to monitor. Price dropped to 85 and bounced precisely from that level. Go verify it yourself. Both the video and the chart are there. I didn't predict a bounce. I gave you the level. That is tape reading education in action. You've seen more real market insight on this channel from one moving average than most paid courses will ever deliver. Remember the swing failure pattern I highlighted when we were trading at 72 and everyone was calling for zero? Now mark Tuesday's 9 a.m. low with a horizontal line and extend it forward. Price found support at the 150 EMA on the hourly, swept that low, and closed well above it. That is a textbook swing failure pattern. Price then moved from 85 all the way up to where we currently sit at 88. These patterns exist across every time frame. Daily, hourly, it makes no difference. You just have to watch. I'm not calling direction. I'm reading what price actually did at a key structural level. That's the gap between guessing and real tape reading. The setup forms, price reacts, and you observe the confirmation. Apply this consistently across futures, forex, crypto, and metals, and you'll start seeing these patterns before they fully develop. A significant low gets swept, price recovers sharply. It happens across every asset class, almost like clockwork, almost as if someone is orchestrating it. That's something I'll leave you to think about. To everyone asking about copper, crypto, and futures, I'm watching. I'm listening. In 2026, I will bring tools and frameworks you've never encountered, methods these so-called mentors don't even know exist. I'll show you just how structured every market really is. I don't need your money. I don't need you calling me a legend. What I ask is simple. Show up, verify everything I say, and tag me on X so I can see your work. A real desire to learn. That's it. That's what will keep me putting out content on this channel. But understand this clearly. None of this signals all-time highs from here. This is tape reading education. Understanding the move, not getting ahead of it. Here's what that manipulation actually bought the CME. Survival for another month. They relieved enough March delivery pressure to get through this cycle. But in doing so, they burned whatever credibility they had left. When the same exchange engineers an identical play at the November delivery and then repeats it in March, even mainstream traders begin connecting the dots. Here's what makes this significant. The last time they ran this same exact maneuver was November 28th. What followed? Silver rallied 120% over the next 60 days, not because manipulation disappeared, but because desperation at this level signals the underlying pressure is very real. When intervention has to be this transparent, you're watching a system losing its grip on the gap between paper contracts and actual physical metal. Edwin Lefebvre documented this exact dynamic in Reminiscences of a Stock Operator, how insiders would engineer violent shakeouts to flush out weak participants before positioning for the real move. Wednesday followed that exact playbook, effective at clearing nervous hands, ultimately just noise against the structural reality underneath. While paper momentum was being reset, physical kept moving. COMEX vault data just came out. 1.3 million ounces drained during the blackout window on Wednesday. 218,000 adjusted out of Brinks registered. 624,000 withdrawn from HSB. 25,000 from JP Morgan. 619,000 from MTB. Total registered silver now stands at 86.1 million ounces. Total COMEX inventory at 360.64 million. Coverage ratio, 0.60. Registered silver covers only 60% of 1 month's open interest. For every 10 contracts,
There's physical backing for just 1.4. And here's the number almost nobody is highlighting. 54.51 million ounces gone in 30 days. A 13% inventory decline in a single month. You can suppress paper price. You cannot suppress metal physically leaving vaults. Shanghai is trading at 97 spot, 100 on futures. Western spot sits at 88. That's a $9 premium holding firm through manipulation, trading halts, and failed breakouts. That is not temporary arbitrage. That is structural separation, revealing where actual price discovery is happening. Now watch what India just did. Their securities regulator approved $385 billion in actively managed equity funds to allocate more capital into gold and silver, up to 35% in precious metal instruments. That's not retail money. That's institutional capital getting regulatory permission to rotate into hard assets at scale. But there's a second development most people overlooked. Starting April 1st, India's regulator directed mutual funds to use domestic exchange spot prices to value physical gold and silver holdings, not LBMA prices anymore. They are decoupling precious metal valuations from London benchmarks, cutting out the currency conversion adjustments, transportation costs, customs duties, taxes, and all the layers tied to Western price setting. As wealth migrates east, so does price discovery. When a market representing $385 billion in managed capital says they'll value metals on their own exchange rather than London's benchmark, you are watching the architecture of global finance shift in real time. Let me show you something else nobody is connecting. Remember Jane Street from the last video? The 20.6 million SLV shares added in Q4, making them the largest holder with a $1.3 billion position. There's another layer to this story the headlines are skipping. The Jane Street lawsuit just exposed how Wall Street actually operates, not the framing about triggering crypto winter. The actual mechanics described in the complaint are far worse. A former Terraform intern named Bryce Pratt, working at Jane Street, created a private group chat called Bryce's Secret, connecting him to Terraform software engineer and head of business development. That chat became a direct pipeline for material non-public information about Terraform's liquidity. On May 7, 2022 at 5:44 p.m. EST, Terraform quietly pulled $150 million UST from Curve's 3 pool. No announcement. Within 10 minutes, a Jane Street wallet pulled $85 million UST from the same pool, the single largest transaction in that pool's history. Combined drain, $235 million UST before anyone outside those two firms knew anything had changed. The peg cracked that night. 6 days later, $40 billion gone. Then on May 9th, while retail portfolios were collapsing, Pratt messaged Duke Long offering to buy Luna or Bitcoin at steep discounts. They front-ran the collapse using inside information, then offered to buy the wreckage, fully aware of the financial condition they helped engineer. This is the second lawsuit from Terraform's administrator. He already sued Jump Trading for $4 billion in December, alleging they artificially inflated UST through a backdoor arrangement prior to the collapse. The Jane Street complaint alleges inside information flowed between the two firms, two of Wall Street's most sophisticated operations allegedly coordinating around non-public information while retail absorbed the full $40 billion wipeout. Do Kwon received 15 years. Terraform paid $4.4 billion in SEC penalties. The institutions posted record profits. Why does this matter for metals? Because these same dynamics, concentrated institutional positioning, information asymmetry, coordinated action during stress events, retail absorbing losses while institutions profit, that's not unique to crypto. That's market structure. And when a Manhattan federal judge is now deciding whether market making became market taking in crypto, understand we're watching similar concentration in silver right now. Jane Street sitting on $1.3 billion in SLV while retail gets locked out of trades. Same playbook, different asset. Let me be honest about what could delay this, because hype serves nobody. CME can continue rolling March contracts into May and July, pushing delivery pressure further out. They've just demonstrated they'll halt trading and flush speculative longs when pressure builds. Shanghai premium could narrow if Chinese industrial demand weakens. And there's always the possibility they run the identical play again at the next delivery window. That is the reality of what they still control. Here's what they can't control. 1.3 million ounces don't drain during a trading halt when market participants trust the system. A $9 Shanghai premium doesn't persist when arbitrage flows freely. India doesn't decouple from LBMA pricing when it expects Western dominance to continue. Registered coverage doesn't drop to 0.60 when supply is genuinely abundant. Open interest at 120,888 contracts against 86 million registered ounces. The math simply doesn't hold, and participants are beginning to see it. These are not theories. These are documented, verifiable, on-record events. Here's what matters most. They cut March delivery pressure by over 50%, flushed every speculative long, and broke paper momentum. Silver still holds $88 with a $9 Shanghai premium, while 54 million ounces disappeared in 30 days. India just opened $385 billion in institutional capital to hard asset rotation and decoupled their price discovery from Western benchmarks starting April. Coverage ratio of 0.60 means the current paper structure has no mathematical support. The last time they ran this same exact manipulation, in November, silver rallied 120% afterward. Not saying that repeats exactly, saying desperation this visible tends to come before major structural moves. This is financial market education, not investment advice. Mainstream narratives will tell you nothing to see here. The institutional math breaking down in real time is telling you something very different. Invest with logic, not hype.